As the Fed continues to scale back its quantitative easing, many investors remain concerned about the timetable to raise interest rates. With me in the studio is Jim Lauder. He is the co-manager of the Wells Fargo Advantage Dow Jones Target Date Funds. Jim, thanks so much for being with us.
Thanks. That's quite a mouthful, isn't it? Thanks for having me, Joe.
So Jim, let's jump to it. People in retirement who have target date funds, they're probably wondering right now what is going to happen, especially with historically low interest rates. Is this something that you're concerned about?
It is, because I think the whole premise of target date funds is that you're going to be reducing risk as you get closer to retirement. So I think a lot of people, their first pass is to associate that purely with equity risk and reducing that equity risk as you get closer to retirement. But I think the environment that we're in now with fixed income, and we've known that it was going to happen for some time, that rates can't stay as low as they have been, is that there can actually be a good bit of fixed income risk, duration risk associated with these target date funds too, particularly as those near retirees, say 5 to 7 years close to retire or near retirement in the first few years after they start taking distribution. So I think it is a real concern that managers need to be aware of in the target date space.
So how do you manage for this?
We're unique in this space. We have a very dynamic model. We really focus on managing downside volatility, and we judge those three asset classes. If you look at the big buckets of equities, long fixed income, and we use cash as a very strategic investment, which is different, I think, for institutional money managers.
Yeah, how so? Yeah.
Well, most people assume cash is trash, and I'm not going to pay somebody to use cash. I mean, that's the old saying in this industry. But we actually use it as a very strategic investment. So in times when there's high volatility, rising rates, downside volatility in fixed income, which could even lead to an increasing correlation between income or the equity market and your long fixed income, we will start to turn to cash to fill up basically what I might refer to as a risk bucket, because once you fill it up so much with equities, if the volatility of fixed income goes up too much, you really need to find other investments to do that. So by levering into cash, short-term investments, we can start to offset that duration risk for those people that are getting close to retirement. We saw that very thing happen, kind of a glimmer of, I think, what could happen in the future. We saw that back in 2013, the first half of the year. We saw that increased volatility in fixed income.
Sure.
We went from a 4% allocation to cash up to 14% within about 6 months.
That's a pretty large jump.
It is a big jump. Now, it happens gradually with our funds. We don't move anything more than about 3% at any rebalance, and we rebalance every single month. But we started to recognize that increasing volatility. The diversification benefits were still pretty decent for long fixed income, but the volatility was such that we had to start looking for something else. So it started to move into cash, and I think that's what you'd see going forward.
Okay.
If you saw increasing rates, certainly with the announcements today, I think that's a real risk. We knew it was going to happen, but when is that going to happen in the industry in total, and what are the responses going to be? So it pays to have a more robust approach to how you actually look at define risk and manage risk.
All right. Well, Jim, thanks so much for your take.
Thanks for having me. I appreciate it. Thank you.
That's Jim Lauder for TheStreet in New York. I'm Joe Deaux.